So in problem 24-1, we're going to look at different ways to evaluate a project to figure out if it's a good deal or not. And so we're going to look at payback period, accounting rate of return, and net present value. And so payback period, that just looks like, hey, how long does it take for us to get our money back from this deal? It just looks at cash, looks at what we paid, and looks at the cash flows. It doesn't take into consideration any type of discounting for the time value of money at all. Accounting rate of return, that's just a simple return based on net income. That's probably the least used method of evaluating a project. And then we're also going to look at the net present value, and that's probably the most significant way to evaluate a project. And so in net present value, we're going to look at the total cash flows produced, but we're going to take into consideration the time value of money. So in this one, we have factory companies planning to add a new product line. To manufacture the product, they're going to have to buy a new machine for $480,000 with an expected 4-year life, $20,000 salvage value. All sales are cash. And then it gives us some information on the expected sales of the product and the expected cost to run the product. And so in the first one, it wants us to compute the straight line depreciation on the new machine. So it tells us that we have a cost of the new machine is $480,000. It says we have a salvage value of $20,000. So the net we're gonna spend is $460 because we're assuming we would sell this at the end of the period for $20,000. And it says that we have a 4-year useful life, which is going to give us annual depreciation of $115,000. Right, and so in number 2 it says determine the net income and net cash flows for the project. And so it says that we have annual expected sales of $184,000 or $1,840. That's going to be same there. And so it says direct materials. It's $480,000. Just happens to be the same as the cost of the new machine. That's just coincidence. Direct labor $672,000. Overhead, not counting depreciation, is $336,000. Depreciation on the new machine we just calculated at $115,000. And then we have selling and administrative cost of $160,000. We have our tax expense, which is 30% of our income before taxes. So that's $23,100. So we want that to be negative. So we have net income of $53,900. And so that's going to be net income, which takes into consideration things that are non-cash, like depreciation. And so now we want to figure out what are the net cash flows that are going to be provided. And so we're going to take into consideration direct materials, take into consideration direct labor, overhead is going to be cash. We're going to ignore depreciation, but we will have selling and administrative cost, and we will still have our taxes of $23,000. So we're going to have net income of $53,900, but we'll actually have cash flows of $168,900. And so now for part 3, we want to calculate the payback period. And so the payback period is simply the cost of the machine, and we want to divide that by our net cash flows. And so, based on these assumptions, it would take us 2.84 years to get our money back after paying for this machine. All right, and so for number 4, we calculate the accounting rate of return. And so for that, we just take the net income, that's $53.9, divided by, divided by our average investment. And so the average investment here is just going to be what we pay for the machine and then we can add in the ending value, which is going to be the salvage value. So if we add these up and then get an average, we just divide it by 2. So that gives us an average investment of $250,000. If we just divide our net income divided by our average investment, that's going to give us an accounting rate of return of 21.56. Yeah. And then the last thing that asks us to do is to calculate. It says compute the net present value of the machine using a discount rate of 7%, assuming cash flows at the end of each year. And it gives us a little hint. It says, hey, make sure we take into consideration the salvage value as a cash inflow. And so to calculate our cash flows, it says we already calculated that $168,900 for each year. With the exception of this last year, we're assuming we're going to sell the machine, so we're going to add an additional $20,000. And so over those 4 years, we're going to accumulate $695,600 of cash flows, but that's going to be undiscounted. So what we want to do is we want to reduce that by our discount rate. And so to calculate the discount rate, you can use it. There's probably a table in your book. Nobody ever uses tables when you have Excel. But, pardon me, we can use Excel to calculate the values from the table. So we're going to actually look at this 2 ways. We'll look at one way, which is probably how your homework is set up, and then we'll look at it kind of just using the power of Excel to calculate the answer, which is far simpler. And so if we want to get our net present values, so we want to take the net present value of 1, and so to do that we just use our present value formula, and first we enter our interest rate of 7%, number of periods, we're just looking at 1 period here, 0 for payments, we're not taking into consideration payments, and we just want to know what the present value of $1 is. And we're going to enter it as a negative just so our answer comes out to be positive. And so that is going to give us our factor for each one of these. And so all we have to do is go in here and change the year to 1, 2, 3, and 4. And so then if we take our cash flows, multiply it times our present value factor for each particular year, we're going to get our discounted cash flows. And so our discounted cash flows are going to be $587,000. And so all we need to do is subtract out our original investment to get the net present value. And so the net present value is $107,358. And so what that means is, so if we have a net present value of 0, that means it's a wash. It doesn't matter if we do it or if we don't. Anytime we have a positive net present value, that means we're going to have profit considering what we paid and considering the time value of money. So any positive net present value is a go. And so we can do this easier than, other than building tables. And so what we can do here is we can just use the net present value function in Excel. So that's just NPV. Enter in our interest rate, 7%, and then we just gotta select our values for each one of these 4 years and then close the parenthesis. And see, that gives us the exact same 587,358 as we calculated up here. Now if we just subtract out our investment, we get the exact same present value and a lot less work.